All right. Good morning, everyone. Good afternoon or good evening, whenever you're listening to this. Thank you for your attention in joining this session. My name is Kyle Olson. I am a member of the RPAG investment team, and I'm going to go through a Q4 2022 market review, as well as summarize, some of the themes that played out over the calendar year of 2022. So looking at the page here, you can see a little bit of differentiation between the larger global capital markets. So we did have some positive performance across the board, across US equities, international equities, and fixed income, climbing out of bear market territory for finishing the year out of 2022. So US equities were up a little over 7%. International equities performed a little bit better than the US, about by double. And then fixed income was also positive, up 1.9%. So finishing the year out of 2022, the US markets were down 19.2%, international 16%, and fixed income being down about 13%. And I'm sure, hard to ignore all the discussion that's been moving the markets, that's been driving the markets. We're hearing it from clients. We're hearing it from portfolio managers that it really has been dominated by these macroeconomic events and the Fed doing everything they can in their arsenal to combat, the high inflation, the high multi-decade high inflation that we've seen. You can see that the Fed raised interest rates 125 basis points during the fourth quarter. And what you'll see here in the coming slides is that in the shorter term, the market's really a voting machine for where people think the market's going to be eventually. And so much of the discussion going into and heading into 2023 is, how much is the Fed going to raise and by how much and when they're going to raise and how much they're going to let, unemployment, which is their second mandate, decline as a result of some of these interest rate increases. But of course, always nice to see, positive performance across the board. Again, bouncing back from what many portfolio managers would say have been really price declines when, the underlying fundamentals of some of these companies have remained relatively stable. Of course, there is certainly a lagging effect, and some of these profit expectations, margins have come down a little bit, but not as bad as what you would expect. Looking deeper into the US equity markets, a lot of great content on these three different areas that you'll see on this page. I'll start on the top left by looking at index performance. So, I mentioned the different market styles of the US markets, value versus growth. And value styles, think of those as more of your financials, energy companies, industrials, materials, utilities. And on the growth side, you think of your more traditional growth company that needs those prospects for future earnings potential and earnings growth potential. So, think of your giant tech companies, your healthcare companies, and biotech companies are folded underneath that healthcare sector. You also have consumer discretionary, which is more of your, think of your luxury goods or any kind of, a little bit more of a cyclical element to consumer discretionary. Those fall more onto the growth side of the spectrum. You could see in Q4, the best performing area was the Russell 1000 value. 1000 are your large caps. So your large cap value companies were actually up into the double digits. And converse that to your large growth companies were actually up by the lowest amount. And that has translated into 2022 as well, with the large cap value companies performing the best, and the worst underperformance came from your large cap growth companies in 2022. However, in the longer term, you could still see that despite these differences in performance over the longer term tenure, you still see dramatic outperformance, almost 4% annualized for large cap growth versus the large cap value names. And right in the middle, the Russell 3000 index, that's your total market index, even with the volatility that we had this year. And we'll get to that and how it relates to how we've performed historically, which is, among some of the worst performing years that we've had. Even factoring in this negative performance, you're still longer term up annualized 12.1% on a 10-year basis. So Really important to put that in context that, again, certainly markets are volatile. We were in a bear market for the better part of 2022, but even factoring in that negative performance, you still have some pretty good long-term numbers. I mentioned growth and value, so we do look at that. And this chart on the top right here looks at a rolling 1-year time period. And so, you could see a lot more orange on this chart versus gray. And you could see that, in the throes of 2020, when, everyone was work at home, stay at home, and except for essential workers, these growth assets had dramatic outperformance. You could see, if you gloss your eyes over to the y-axis here, between almost 40 and 50% outperformance versus value assets. Well, that has since reversed. And these numbers, the last time we hit those extremes were during the dot-com crisis, the turn of the century in the early 2000s. And now that has since reversed with much more of a focus on these value companies. And one aspect of growth versus value, and really more of a misnomer, I would say, is that many would think that value style investing is safer than growth style investing. I'll point out that in value, there's certainly just as much risk in growth investing. If you think of a traditional value company, if you think of a blue chip bank, that one can argue has a much more conservative profile versus a giant tech company or a company like Tesla, for example. But on the value side of the spectrum, you also have energy, which is down on the bottom here. Energy makes up about 5% of the US market, but you can see that energy stocks were up almost 64% in 2022. Compare that to the worst performing sector, telecommunications, down 39.7%. So you have almost a 100% difference between the best performing sector for the year and the worst performing sector. And so, what we will say is, value has come back into favor. There's generally been more of a preference away from some of those high-flying growth companies that some would argue trade at lofty valuations. But you also have some of the more riskier areas within values doing so well with energy companies specifically. We've heard from portfolio managers, even on the growth side, energy makes up much more of a presence on the value side of the style map. We've actually heard from some growth equity managers that they're starting to increase, or they had at one point in 2022, started to add some of their exposure to energy just to sort of make up for some of these very strong performing numbers that you see here. Of course, it's important to look at the longer term, and you can see energy over the longer term is actually the second worst performer over the longer term, next to telecommunications. And of course, we always preach to have a balanced approach across growth and value. You never know when these things are going to fall in and out of favor, especially with a sector like energy. Of course, the funds that we recommend are more all-encompassing of multiple sectors and not specific ETFs that or sector funds, if you will, that dive deep into any of these different areas. Looking at the international markets, a similar theme is playing out between growth and value, where you see these value assets performing much better than the growth assets. I mentioned at the beginning of the market review that international equities have broadly outperformed the US equity market. And that really has to do with two main points. One is that valuations for international equities have been depressed for quite some time relative to their long-term averages. We've heard from various asset allocators. Think of your target date fund managers, for example. Many of them, you have to make that active decision how much you want to allocate between US and international equities. And historically, international equities have been a diversifier to the overall equity markets. But if you look at the last 10 plus years, it's really been the US outperforming. And if you look at international markets from a fundamental standpoint, if you look at price to earnings ratio, for example, international markets have been trading at a discount for quite some time versus their longer term historical averages. But what I think is probably the more important point as to why international equities have been outperforming the US is because they're constructed differently. The US and think of it from a sector standpoint and style standpoint, the US market has significantly more growth-like exposure and specifically technology exposure. There aren't any sort of Google, Apple equivalents overseas in the developed international markets. And so, much more tech exposure in the US. You could see that the US has really been in the driver's seat for the last 10 years, and only recently have international markets start to come up and do well. Another thing to point out here in the international markets, you see emerging markets, the MSCI Emerging Markets Index underperforming the MSCI EFA Index. The EFA Index, those are 100% developed economies. So think EU, UK, Japan, and then emerging markets, the bigger constituents there are Brazil, Russia, India, and China. Despite Brazil's economy being so tight with the energy markets, you still have underperformance in the emerging markets versus the developed markets index. And a lot of that has to do with China and some of the macroeconomic headwinds that are going on there, their ability to foster a soft landing, as well as some of the regulations that they put in place on some of the technology and real estate, or really across a variety of sectors in their markets. So not to mention, the zero COVID policy and some of those, like I said, macroeconomic factors that are affecting those markets. So developed markets did a little bit better than emerging markets, but I would also say that there is a little bit more tech exposure in those emerging markets categories. On to fixed income. And I have some charts later in this presentation that talk about fixed income in greater detail, again, putting it in context. On the top right, you look at the yield curve and where we were at a year ago versus where we're at today. This is yield curve today, as in 12/31 ending. You'll actually see the yield curve is inverted, which means that your shorter term rates are actually higher than some of your longer term rates. This has historically preceded a recession, or if you look at some times when we've entered into recessions, there's been sort of a lag between when the time the yield curve was inverted to when we actually entered a recession. And so, again, if you think you're in an investor seat, why would you invest in longer term rates that are lower when you have shorter term rates? You get your money back faster with the higher interest rate. So certainly one thing that many people are paying attention to is that yield curve, that inverted yield curve. But one thing, of course, the negative market performance in interest rates, created the worst year for fixed income. But now we're at a point where you're seeing yields anywhere between 4% and 5%, and this just looks at the Treasury yield curve. Of course, your typical fixed income fund in your plan, has a yield anywhere between 4 and 5, maybe even greater than 5%. So we saw a very interesting chart earlier internally that if rates continue to remain the same, you could be looking at just from a yield pickup of about a 5% rate of return. Of course, that's always in a vacuum, depending on where interest rates go, higher or lower. If they go lower, the fixed income will actually have stronger and outperformance. And of course, vice versa, if the Fed continues to raise rates aggressively and that fosters increased rates across the curve, that can certainly have an impact on the total return of a fixed income investment. One thing I also, I've been having many discussions with clients about is that TIPS exposure, which is on the bottom of this page, and I'll try to make it just a little bit bigger. The Barclays Aggregate Bond Index was down 13% in 2022, and TIPS stands for Treasury Inflation Protected Securities. So on its face, many investors would think, TIPS is a safe haven for, an inflationary environment. But many people don't realize that TIPS are bonds, and bonds have interest rate risk. And TIPS tend to have a duration anywhere from 6 to 10 years, depending on which area of the TIPS curve that you look. But you see TIPS, outperformed the aggregate bond by just a little over that 1%. But even investing in a category like that has inflation protection in its name, you still have this negative performance despite the multi-decade highs of inflation that we're seeing. So there's certainly more, we would say, interest rate risk as opposed to inflation risk in these securities. And, whenever we get asked, should we have a tips fund or a dedicated tips fund, we tend to roll that into a more diversified portfolio like a target date fund. Your target date fund is going to have exposure to not just tips, but other inflation protecting asset classes. Think global real estate, think commodities as well. So again, think more refined in a professionally managed portfolio like a target date fund, a balanced fund, or a managed account. Here's our asset class kaleidoscope. Some people call it a Skittles chart. Some people call it a quilt. You'll see all the different colors here, and what was once the best performing asset class one year can easily be the worst performing asset class the next year. And I'll just point to 2022 as an example. All of these macroeconomic events, coming out of the pandemic, Russia invading Ukraine, really sent commodities in a very volatile place across all commodities. But you can see here, finished 2022. Commodities up 16.09%, whereas historically, commodities have been the worst performing asset class. We really didn't have inflation for almost 10 plus years leading up to 2021 and 2022. And so we always preach to have a balanced index, a balanced portfolio, which is that yellow box in the middle. You're never going to be the best, you're never going to be the worst, but really smoothing out that ride, especially in an account where you're dollar cost averaging and you're putting in steady contributions, you will fare out better in the long term, as opposed to picking one category, which can lead to bad decision and potentially bad outcomes, and staying diversified and really weathering the storm when markets are south. 2022 just happened to be a year where typically fixed income is meant to be that ballast in the portfolio, but we saw precipitous interest rate increases and negative performance. We'll talk a little bit about, like I said earlier, some slides later on that show just the context of the negative performance and how bad that performance was last year relative to history. Here is our chart of the quarter. I realize that this is a very busy chart with a lot of numbers, but we thought that this chart, this heat map, if you will, gave a really good picture of inflation, and not only what inflation, CPI, how that rose from 1.3% in December of 2020 all the way up to almost 9% in June of last year. So you could see the different weightings to CPI on this left-hand column: energy, food, core goods, core services. So specifically shelter, some of these areas that make up a bigger component, a larger component of CPI. And you'll see these month-to-month increases or decreases color-coded in red and green in various shades. So, you could see, what happened in that first part, really led to some of the strong higher numbers in inflation. You can see going all the way across from 1.3, heating up effectively right in this 2022 region, specifically in June. What areas were the bigger areas of growth? And you could see, which ones kind of went first as well. CPI year over year, again, you're looking at 12 months time period. So some of these numbers here, some of these older numbers are picked up in some of these CPI readings. So initially coming out of the pandemic, if you were in the market to get a used car or any kind of car, you really felt that squeeze. And you can see these huge increases here in 2021, specifically in the used car market. And then you look at the geopolitical situation with Russia and Ukraine sending energy prices skyrocketing. You can see that happened in that March timeframe. Gasoline up 18.3%. So you can see a combination of these, as well as the food prices coming in a little bit higher than normal. And then following that later is the shelter component, which is the OER, stands for owner equivalent rent. If for those that are renting out there, you saw rent increases occur in this time frame, and you're starting to see some of these, or really all of these, are coming down a little bit. And so Another thing to note about the year over year headline CPI, now that we have, we're well into 2023, or at least a month and change into 2023, some of these numbers, some of these older numbers are rolling off that year over year number. So we thought this was just a helpful chart, even though there are a lot of numbers here, just to see the sources of inflation, and they came at different times, and how that all rolls up in terms of their individual weightings as a part of that total CPI calculation. So next, we have a couple of charts from some of our investment manager partners. Of course, we do our own research here at RPAG, but we also lean on some of our fund manager partners for their expertise. And we always find and try to extract some really good talking points or really good factoids that you might not necessarily read, in your day-to-day publications. We thought this was good, coming from BlackRock, that just put the bond market in context. So the Barclays Aggregate Bond Index had the worst year since 1926. Again, rapid interest rate increases, unlike anything that we have ever seen. And you can see the next worst performing year, around 2-3%. And so we are, definitely in that, unprecedented category here. And what you'll see is the next 12 months, usually, markets are cyclical or mean reverting. If interest rates come down this year, potentially that could bode very well for bondholders. But it's interesting to see that the strong performance on average, following a pretty bad year in the bond markets. You can see the average return going back to the 50s at 6.2%. It was also the 7th worst year for U.S. stocks going back to 1926. So you see some of these horrific years here, in the Great Depression, the global financial crisis, and the dot-com crisis as well. And it also shows the subsequent 12-month performance. Like I said, the stock market tends to be a voting machine in the shorter term. And, this is volatility at its highest. You tend to find that the next 12 months or the next shorter time period, because we would consider 12 months even being a shorter time period, tends to bode well after these significant down markets. We're already starting to see markets positive so far in 2023. Fingers crossed that it stays that way. I thought this was an interesting chart or graphic from Prudential Global Investment Management. They did an internal survey with their macroeconomic team that looked at some of the bullish factors, bullish sentiments that are likely to transpire or would likely aid in our equity markets doing so well, our capital markets doing well. And on the flip side, what are the risks? So what do you think is the biggest risk to the market in 2023? I wanted to just show this as a sampling of what, macroeconomic teams are looking at when they're making these projections or when they're looking at various risks. There can very well be a case where there's a bullish case that's not listed here, and vice versa when there's a risk that's not even listed here, because you never know what could happen. And we tend not to make predictions. We don't want to get into the business of, that's a crystal ball, or anyone who can do that successfully and sustainably over a long period of time is a very gifted individual. But I thought this would be just good to highlight what is out there that people are thinking about. Of course, on the bullish side, you have the resilience of the U.S. consumer. Again, U.S. GDP, 2/3 of U.S. GDP is based off consumer preferences and consumer demand. You also have the China story, now that they're going through the worst of the pandemic and they're growing, and you have the central government in China wanting to do everything they can to put China in a great position going forward in the markets. So you have that sort of growth story coming out from a low point. You have inflation. If for some reason the central banks tend to get a hold on inflation and it does go down to that 2%, that could really bode well for us and for everyone in 2023. Some kind of resolution to the Russia-Ukraine war, and then also, any kind of public investment that raises innovation potential GDP. So, I think that was probably you could see it was the least appreciated bullish wildcard factor for 2023. And of course, the biggest risk that was, pretty clear and evident from the team at Prudential: high inflation, central bank tightening, leading to, tightening to a global recession. Then you have some of these other things. Maybe China has a hard landing instead of that regrowth, that growth acceleration story. And, you never know from a geopolitical standpoint what can happen and how that can also play into that negative energy shock if something escalates abroad. Inflation, this just looks at all the different markets. Inflation is high across the board, just at a very high level. You have the US, and this information was towards the end of last year, around the November timeframe. So this 7.7 has actually come down even further here for the US, but inflation remains high across the board, specifically to the EU and the UK. I thought this was a fantastic chart from American funds that actually looked back to 1950 all the way to 2021 and isolated the times where we entered recessionary territory versus expansion. And in the market, in the stock market, you have bear market and bull market. So really combining the market-based factors, judging by the performance of the S&P 500 index versus its underlying industrial fundamentals. So you think of GDP growth, corporate earnings, jobs added, and you'll see the various stats down here that they analyzed, what were these various factors in these recessionary periods versus expansionary periods. And it kind of makes sense. You have positive GDP growth, you have a significant amount of corporate earnings, you have new jobs added during these expansionary time periods. And then in recessionary periods tend to last about 10 months in duration, and you have contractions in all these three areas. You also have the different periods where we had bear markets. Of course, this year was one of those versus bull markets, and the total returns in those different environments. And I think what was the most impactful point of this chart is right in the middle here, where you can see that the market has tended historically to peak about 7 months prior to the recession actually beginning. Of course, as a reminder, recessions are labeled after the fact. Of course, there are some various circumstances that would require, it's not necessarily just 2 consecutive quarters of negative GDP growth. And who denotes a recession, like I said, does that after the fact. So I thought this was impactful to see that, the market tends to peak before the recession actually happens. And it also tends to recover before the recession ends, on average about 6 months. So again, back to my earlier comment, I mentioned it a couple of times that the market is essentially a voting machine. Markets tend to react quickly to these and tend to either overshoot or undershoot on the way up. So again, of course, we preach long-term buy and hold investing. These are retirement investors. So we just try to do our best at educating that, often these times, there is that disconnect between what the market is saying versus what the economy is actually doing. Again, some more comments on bonds. I think I hammered them good enough, but just wanted to put these again in context. Worst calendar year ever. The previous worst period was in 1994. And then the performance following that was very good. Of course, one time period, one size of one sample size, but we looked at that other chart that showed on average, you get a little bit better from bonds after such a poor performing time period. We hit our worst 3-year period ever as of October ending. First time bonds lost money over a 4-year period and a 5-year period. And we've actually hit our worst 10-year period ever, which, kind of makes sense given the number that, the big magnitude number that we saw. And this is going back to 1926. So you'll see here, following these 4 time periods, you have positive performance. And so again, like I said, we want to think that the worst is behind us from an interest rate standpoint and from a fixed income standpoint. And wrapping things up, I thought that I always try to include a slide similar to this, similar to our asset class kaleidoscope or Skittles chart, showing the importance of diversification and a diversified portfolio. So this looks at the S&P 500. This looks at a diversified portfolio, which you could see the allocation here: large cap stocks, mid cap stocks, international, small caps, emerging markets, US bonds, and high yield bonds. And you'll see that this looks at over the highlighted column here is over a 20-year time period. There are certainly times where, even if you're invested in a diversified portfolio, you may feel like it's not working. compared to some of the other categories. So, during the dot-com crisis, diversified investors still lost money. So, the loss aversion is very real there. But however, if you look at some, really one smaller time period in this area where diversification actually outperformed the S&P 500, you still think 2008 was a bad year for diversification. Even looking at 2022, a diversified portfolio still had a pretty negative return. But over the longer term, you still have outperformance versus the stock market, even in a time period like 2020 and 2021, where you have over 100% return on the equity markets. You still feel that those diversified investors still feel like they didn't make as much as their counterparts who are in the equity markets completely. So diversification, I think this is the key point here. Diversification can work even when it feels like it's losing. So again, a lot in store for 2023. Again, hope the worst is behind us from the fixed income markets. And thank you all very much for hanging in there and paying attention, and have a great rest of your quarter and a great 2023. So thank you very much and have a good rest of your day.